division. So that's us in terms of Morgan & Co. Just introducing the team. Of course, I'm Batanai Matsika. I head up the research team here at Morgan & Co. With me on this webinar, specifically, we have Tafara, who's a senior analyst, and Cornelius. They're also on the research desk. And also in terms of sales trading, we do have David, Lungani, and Tatenda. These are the guys that are in the front office that are, interact with clients like yourselves on a daily basis. So that's the team behind Morgan & Co. So the purpose of the conversation today, of course, is to talk about the Morgan & Co. multi-sector exchange traded fund, an ETF that's about to launch. We're basically looking at a launch date of 3 January 2022, when it's going to be listed on the ZSE. So the purpose really of this presentation is just to give you an overview of the ETF itself and why we think it's an exciting proposition for retail and institutional investors out there. In terms of the presentation, I'll basically cover the basics in terms of what is an ETF or an exchange traded fund, and also talk to the global rise of ETFs. Of course, we've been seeing a lot of activity on that front, a lot of interest globally, and going to the Morgan & Co. multi-sector ETF, talking about the fact that it is actively managed, and we'll also cover some of the advantages and risks associated with ETFs generally. So that's the whole concept. I'll go straight into the presentation, just covering what an ETF is. So an ETF is a basket of securities. I mean, just putting it simply, it's a portfolio or a basket of securities that you can buy or sell through a brokerage. So what we're doing really in an ETF, we are creating units out of an existing portfolio that we actually come up with. So really in terms of how they are structured, the underlying asset class could be anything from traditional investments such as your shares, even to things such as commodities and currencies. So that's the basic, definition of an ETF, but it's worth noting or highlighting that, they can be structured around a lot of different kinds of themes. Some are called index tracking ETFs, whereby they take a particular index. From the ZSE, we know there's the top 10 index. What it does is it's sort of an index tracking ETF, which tries to track the performance of an underlying index. So a lot of strategies can be used, but specifically for ours, as we'll discuss later on, it's a bit different from what's currently there in the sense that it is actively managed. But just taking you back, I think from a global perspective, there's been a lot of interest in ETFs, a lot of advantages from efficiency point of view. So we've seen a growth in terms of global ETF assets. We're now looking at something around 9.5 trillion in terms of total assets. So we expect this to continue to grow. Even in markets such as Sub-Saharan Africa, we've seen the introduction of very exciting ETFs being modeled around stocks and even things such as gold. So the next question will be, what exactly is an actively managed ETF? So this is the proposition, this is the story that we're presenting to the market to say that this is not an index tracking ETF. So here we are actively managing the portfolio on a continuous basis, making decisions in terms of what to buy, what to sell. so that, by the end of the day, you get the market beating returns. So we're not just tracking an index, but we are making decisions based on fundamentals continuously. So this is going to be the first actively managed ETF. Of course, we do have the top 10 index, which is run or managed by Old Mutual. But for the Morgan & Co one, it's going to be the first actively managed ETF. We're quite excited about the proposition here, given that there's an opportunity to actually outperform. And then moving on to the multi-sector ETF itself, right? How is it going to be structured? It's pretty much the simple way whereby we do have a multi-sector fund that sits and is being managed by professionals, and of course, it's going to be invested in multiple sectors. So we're looking at stocks, of companies within Zimbabwe, and okay, we do have some feedback. I'll just try. Okay, so sorry about that. We have some feedback. So just make sure that you're muted. So just in terms of the structure, we're basically looking at an ETF that will invest across multiple sectors. We're looking at financial services, real estate, and areas such as industrial companies as well. So there's no inclination for this ETF to invest in a particular sector, but there's that freedom really to choose the best performers across the various sectors. So that is how it's going to be structured. In terms of investors, they'll be able to get units through any registered or authorized broker in Zimbabwe for cash. And the managers, of course, will be TN Asset Management Company. But in terms of the the research that goes into this fund, Morgan & Co research will be quite instrumental in terms of pitching the underlying constituents. So that is the initial kind of picture in terms of the constituents that we're seeing on that ETF. So we're looking at financial services, but the exciting thing here is that we do have Old Mutual Zimbabwe Limited in this multi-sector ETF. Old Mutual Zimbabwe is listed on FinSec. It's quite illiquid and the visibility has not been exciting, but the good thing is that we're looking at around 50% of the portfolio to be in Old Mutual. We think it's an exciting blue chip. So we're bringing Old Mutual Zimbabwe from FinSec to the ZSE, where you can actually have exposure, and we're also providing liquidity at the same time. So that's the exciting proposition there. We think that currently financial services, more specifically insurance companies, are quite cheap in terms of the relative valuations that we see on the market. So that's the initial kind of picture. But of course, this can change or will be changing as we go into the future, because this is remember, is actively managed. Right, so just to give you a picture around valuations, right? So as indicated, we're seeing opportunities in the financial services areas where we have multiples forward PE ratios well below 10 times. And we think that, it presents an exciting, proposition for investors, really. So that is why the initial strategy is to go into the financial services sector. So we then move on to the key features of the Morgan & Co multi-sector ETF. I'll leave this one for my colleague, Cornelius, who will take us through the key features of the ETF and also touch around the advantages as well as some of the risks associated with the ETFs in general. So over to you, Cornelius.
Good afternoon, guys. Hope you're well. So I'll go through, this slide is mainly the advantages of investing in our ETF. And these are as follows. So first of all, you're going to get exposure to the financial services, the telecom sectors. So you'll get exposure to the financial services sector through ZHL, FML, OMZO, Capital Bank. And then in the telecom space, you'll get Econet Wireless. So this offers immediate exposure rather than buying the assets individually. You just need to buy a unit of the ETF and you have exposure to all these underlying assets. And another advantage is that you have exposure to the relatively liquid blue chip counter OMZO. Since it's trading on a relatively new exchange, FinSec, it hasn't had much exposure this year in terms of buyers and sellers. So if I tried to go into FinSec and buy OMZO, like a large quantity, it'd be quite difficult to obtain that. But through this ETF, since we're basically in charge of creating the liquidity in the ETF, people can create value through exposure through OMZO, through our ETF. So I think there's a great opportunity in terms of that. And ours is actively managed, which is probably the most important defining feature of the ETF. So we're basically able to adjust the underlying portfolio according to our investment appetite and our research. Whereas with the passive one, you're basically tied to an underlying index. So you're at the whim of the market. With us, we basically dictate which direction we choose to go in and which direction the fund chooses to go in. And because of this, we come to the final advantage, we have better risk management because we can manage our risks on an active basis rather than following an index, which can change over time without our control. And these are the main features of our ETF. So 80% of it will be invested in the financial sector, insurance, and real estate sectors, while 20% will be in industrial and non-industrial. But it's very important to note that since we have the freedom to change the underlying portfolio, this composition may change. So this sort of works like a guideline. So I urge everyone to look at the prospectus when we do publish it. Should be end of this week or early next week. And then you can get an idea of the legalities within the document and sort of the leeway that we have. And in terms of advantages, more advantages, I should add, our ETF is easily accessible. So anyone who has a CSD account can just go on the ZSC, buy and sell units throughout the day, and basically derive value quite easily through normal means. So there won't be an accessibility issue. It's not a VIP asset, it's just an asset that you can purchase quite easily. And it's cost efficient as well. So ETFs on the ZSC incur the same costs as equities. So that will give you a breakdown of those costs. Here we are. So the total is 4.13%. So you basically get the same costs, but you're able to divide this amongst a basket of securities. So essentially, it's more cost effective because instead of just buying one asset and being subjected to one singular cost, you can buy multiple ones which incur the same cost, and it's shared amongst the underlying assets. We can move on to the next one. Another advantage is that it's transparent. So in a unit trust, the manager has no obligation to disclose the underlying assets. But with an ETF, we basically have to publish and illustrate to our investors what exactly makes up our portfolio. Therefore, investors will be aware of where they're putting their money. which allows people to understand what exactly the risks are and the direction of the fund. And again, as we say, exposure to liquid counters. So some counters within our ETF may also experience periods of liquidity if we are trying to buy them separately. So let's say if we end up putting Netfoods in our underlying, Netfoods is quite a liquid stock, but you can gain exposure to it through our ETF. And most importantly, it's very flexible. So, once again, I come to this point of where we can change our underlying portfolio, we can change the number of shares, we can basically just choose which constituents we want over a certain period of time as market dynamics change throughout the year. We can move on to the next one. So with active management over passive management. With active management, we seek to beat the market. With passive investment, you're basically seeking to stay in line with the market and its performance. But due to our strategy of actively managing the ETF, on a day-to-day basis, we'll be seeking to offer market-beating returns. We're not guaranteeing market-beating returns, of course, but that's basically our strategic advantage as compared to a passive ETF. And it's based on a proven proprietary model, which in our research department, we work on a daily basis, where we basically look at the EPS growth of various companies, and we use different forecasting models for each company, whether it be on the FinSec, VFX, or ZSE. And basically, we'll be giving TN Asset Management the instructions as to how they should change the underlying portfolio based on our research and our projections going forward. And I'd like to believe that our research team is heavily qualified, to do so. So yeah, there's a big advantage for us. And then the risk. Every investment comes with a risk. So I think it's important that I cover some of these risks. So the first risk is market risk. So that basically, entails market downturns or market upturns. Anything can happen in the market. We know how turbulent and volatile the Zimbabwe Stock Exchange is. So over time, these changes in volatility will obviously affect our underlying portfolio. So investors should be aware of this and just keep watch on the performance of the market as a whole. And then we have expense risk. So expense risk, we will definitely incur more expense in terms of our expenses managed ETF because we're trading more frequently. But of course, you guys don't experience this cost. This is more of an in-house cost. So it also actually works as an incentive on our part because we have to make returns over and above the cost we incur. Whereas with the passive ETF, there's less trading, so less trading costs. And we have trading risk. So yes, although the ETF is cost efficient, investors will still experience trading costs at 4.13%. And these may erode your returns if the ETF is not performing up to the standards that we set out. So investors should still be kept aware of the fact that they still incur costs, even though they are more cost efficient than in other assets. And then we have closure risk. Globally, about 100 ETFs close per year. So there is that risk that we don't perform as well as we had hoped, that the ETF closes. But the possibility that everyone should be careful. We have methodology risk. So this may follow companies that seem undervalued or overvalued at a certain point in time. Our forecasts and projections may be wrong. It's easy to make such mistakes. Forecasts are forecasts. We can wake up tomorrow and have a different currency. That changes the whole dynamic of the business world in Zimbabwe. So we have to be, realistic in terms of, prowess and experience. And the last one is sector risk. So at a certain point in time, for example, the initial underlying portfolio, it largely consists of financial services companies. So if the financial service sector experiences an exogenous shock, this may then directly affect the returns of the ETF because the underlying stocks will be affected. So of course, we then have the ability to navigate all of these risks because we've put in various risk mitigation measures, as well as the fact that it's actively managed. So we can mitigate a lot of the risks that I've stated. These Sorry, that's not.
Yeah, great. Yeah, thank you, Cornelius, for the overview on the features and the risks. So that takes us to the discussion part. I think this is the most important part where we have to discuss. If you have any questions, feel free to ask a question or just use the chat platform so that we discuss further. So I'll also send this presentation via the chat platform. I'll share it right away, but feel free to ask questions and let's discuss. So there's a question that says, please share more detail on the actively managed part. No, I think Cornelius has done some justice in terms of differentiating between an index tracking ETF and that which is actively managed. So remember, with an index tracking ETF, you're pretty much rebalancing according to the index itself. But with an actively managed one, you are basically looking at where the opportunities are in terms of potential alpha returns, and you're investing in the underlying stocks on a continuous basis. So that is where the difference is on the actively managed part. So this is not like a passive investment vehicle. It's really being managed continuously. And then there is another question from Tinashe, which says that in regards to being actively managed, how often do you expect to rebalance the underlying portfolio? So you'd note that, as in terms of our own in-house stock picking model, we continuously updating our estimates based on new information that comes up. So usually, market moving information will be your results. So basically, you're looking at your quarterly updates and things such as your half-year results. So roughly, I would say, for a start, it could be quarterly, but of course, depending on the news flow that we see, it could change, more frequently. So for a start, I'll say maybe on a quarterly basis. And then there's a question, Cornelius, you can take this one. Thank you for the presentation. Will the ETF include stocks from the VFX in future?
So generally, we have a VFX ETF in the works, actually. So that's something we're planning on listing sometime next year, hopefully probably second quarter of next year. So that's when we'll bring the VFX stocks to the fore. We don't want to dilute this one with the VFX stocks. I think it's better we have one dedicated to the VFX. So I hope that answers your question. Look forward to that ETF.
Okay, thanks. When is the ETF going to be introduced to the market? And may you explain the process of introduction? Is it like initial IPOs? Tafara, you want to take that one?
Thank you, Takunda, for that question. So yes, it's just like an IPO, but instead of it being the traditional share being issued, it's a basket of shares, and the units of that basket are the ones that are being IPO'd. So we do what we call a roadshow, just assessing the appetite out there in the market, to see, what's the appetite like for this instrument. And we've been doing that for the past couple of weeks. And yes, we've seen some appetite for this instrument, especially among some asset managers in Zimbabwe. And then we then proceed to list the instrument. There's also a difference in the price. With an IPO, the financial advisors usually dictate the opening price for this thing, and then there's some sort of price discovery. There's a bit of subjectivity, and people have different opinions on the value of a company. But within ETF, it's much easier because the underlying assets are publicly traded, so we have the actual the value of the asset. So in that case, it's easier to see what the value should be for this ETF once it starts. It lists at the beginning of next year. I think that's the gist of it.
Okay, thanks, Farah. Probably just to add on the appetite front, in terms of dates, we indicated 3 January as the listing date on the ZSE, but already we're seeing a lot of interest from mostly institutional investors. So the initial idea was to sort of have a portfolio around, in terms of total assets, around 500 million, but the scope also to actually push it up to 1 billion ZWL, given the interest that we're seeing. So I guess it's an exciting opportunity, especially for retail and institutional investors to sort of take a position in the initial stages. Of course, there's that IPO effect, that we also expect to play out. So there's a lot of interest, definitely, in terms of access on platforms such as C-Trade, ZSE Direct. What we've seen, especially with the top 10, there was a bit of a time lag, right, before it was available on those platforms. But of course, you can come through directly, to brokers. We'll be able to execute some buy orders for you. And then the next question: are there plans to launch other actively managed ETFs in future? If so, how will portfolio construction strategy differ from this one? As indicated, this one is for the ZSE, and there's also some plans to do something on the FX. But of course, we think that the investment strategy that we are presenting out there is proven, in the sense that a lot of successful portfolios are hinged on fundamentals. So we might change one or two things around the specific sectors, but in terms of the overall methodology around fundamentals, I think that's quite solid. We don't expect to change that. So that will be my answer to that one. And then any consideration on including mining and agro-focused stocks, taking into account that these are some of the key sectors significantly contributing to the economy. Yes, our strategy is not sort of sector specific. Of course, we've started with financial services where we think there's an opportunity, but if you find a stock within the agri space, or even in mining, nothing stops us. That is why we're saying that we have the flexibility in terms of identifying any stock that's out there that we think could present good returns. So we're quite flexible, and this is one of the the key advantages of investing in the multi-sector ETF that we are pushing out. What is the ideal holding time for the ETF units? Cornelius, you want to take this one?
I think it depends what your investment horizon is. When do you expect to see returns? What are you in it for, long-term gain or short-term gain? I think given that our ETF is based on fundamentals, I would say, it's not an asset that, you expect returns over a short period of time, then, they turn into losses. This is something that you hold for, to add value to your portfolio because it's based on fundamentals. But it definitely depends on what you want. Do you want to have capital appreciation for the long term, short term, or medium term? But I personally hold the ETF for quite a while because I'm a long-term investor. I know the other individuals would want to take out profits more frequently than I would. So yeah, this really depends on your preference.
Okay, thanks Cornelius for that. So pretty much it's a long-term, medium, long-term. We think that for you to actually get the benefit, in terms of fundamentals, you need to have a much longer, holding period. And another question, maybe to Tafara, does this choice of constituents represent your current economic projections and equity strategy for the next year?
Yeah. That's the question. So, yeah, in a nutshell, yes, because we, as Morgan & Co, have a research department that deals with we forecast using some models that we have to determine where there's value, and then we take positions in those counters. But how we do that, it all starts with our outlook for the economy all the way down to specific stocks. So how we invest or how we trade in the stocks, how we recalibrate the portfolio in the ETF essentially represents our current economic projections and which stocks we think are going to be winners, ideally in the 12 months from the date that we do any rebalancing. So yeah, that's your answer.
No, thanks. I think it's quite clear. Of course, in the forecasting, methodology that we use, of course, we incorporate all our economic projections and things like that. And another question is, you have avoided the top 10. Is it because they are in another ETF or you see a higher return in the pit stop? Yes, I think you've answered the question to say that we see better returns currently in financial services, and more specifically, if you're looking at Old Mutual, initially we would have a 50% weighting in Old Mutual. I think it's a stock that we continue to view as a blue chip company that has a lot of potential, significant market share, a strong balance sheet, and things like that. But it sort of lagged the visibility, and we are actually bringing it to the fore to say that you can actually have exposure in Old Mutual using this multi-sector ETF. So that is where we see the opportunities. Of course, we can change as we go, but currently, in terms of relative valuations, that is where we see much a significant upside. I may have missed this. Is there a market maker? Yes, of course, there's a market maker. Cornelius, would you want to talk about market maker?
So in terms of market making, we're the market maker for the ETF. So basically our job for market maker is creating liquidity and getting the units from TN Asset Management and finding willing buyers and willing sellers. So of course it will depend on our prowess as a stock broker, and we do have quite a vast client base. So I think our market making capabilities will more than satisfy value creation assets.
So yeah, the market maker is Morgan & Co. Yeah, so I guess it answers your question. So there's a question also on dividends. So yeah, that's a, there's a standard way in which dividends are paid. Of course, given that you have units, you just get your share. If there's underlying stocks that pay out dividends, you actually get your share in the normal way. There's no like dividend, reinvestment programs where when you structure these ETFs, so you actually get your payout in ZWR. And then, where is the value proposition? Is it portfolio growth or dividend? If later, often in a year. So that's a question from Nepson Moyo. I think the proposition here is on the prospect for capital growth. I don't think currently, we have very exciting, dividend payouts. Of course, that could change as you go, but we think that there's significant scope for re-ratings from a share price point of view. So we think the value proposition is on the portfolio growth. I guess we've covered most of the questions. Please feel free to ask questions. Of course, the prospectus will be coming out anytime soon. It will also have finer details on the mechanics around this ETF. But in terms of the dates, 3 January will be listing on the ZSE. Maybe Cornelius, do you want to talk about the timelines in terms of the program itself? Yeah, just timelines as we conclude.
Okay, yeah. So I've seen a question on the weightings, but currently we're not allowed to disclose that information until the ZSE has given us approval for publishing. So right now it's with ZSE. They've approved the ETF, of course, otherwise we wouldn't have this presentation. But they're just finalizing the final details of the prospectus, and we should have it with us on Friday, and it should be published on Friday or latest Monday. And yeah, everyone will be able to see all the fine details. And we have a listing and launch ceremony on the 3rd of January, where the asset will start trading. So those are the timelines. So by Monday, an official prospectus should be out for everyone to see on our website. And I'm sure TN Asset Management will also put it on their website.
Okay, so Cornelius, can you just highlight how, say, a retail investor would actually have access in terms of the process? Where do they go? How do they place an order? What's the minimum and things like that?
Okay, so in terms of retail investors, it's just the same process as with equities. So either they can use C-Trade or ZSE Direct. And for those that want to put in a lot more money, let's say 100,000 bond minimum, then they can come through directly to us as the broker. And we give them account opening forms, and we just do the normal KYC process. But generally, the whole process doesn't differ from equities. The only part where it is different is that investors can actually manufacture their own units. So basically what they have to do is purchase stocks in the same constituents and proportion as in the ETF, and they can come to an authorized participant, be it us or TN Asset Management, and we'll then be in charge of converting your holdings into respective units. So that's the beauty of it as well. So if you hold, let's say, our whole portfolio in the same exact weights or even more, then you can come to us and we'll create the weights for you, the units for you. And yeah, you can buy and sell on the exchange.
Thanks for that, Cornelius. I think it's quite clear. There's a question around how inclusive is this to investors abroad? So of course, the Zim capital markets have always been open to internationals. So you can still participate in the normal way in which foreign investors buy into ZSE or FinSec stocks. So the key highlight here is that this is ZWL. So you have to invest your money in ZWL. Yeah, so we are pretty much open to locals and foreigners as well in terms of this ETF. So I guess this concludes our presentation. I hope it was helpful in terms of just giving you an overview of this exciting product that we're going to be listing on the 3rd of January. Of course, more details are following in terms of the actual prospectus, where you also get a feel of the mechanics and the constituents. But in terms of strategy, we are pretty much looking at where the money is. I think this is sort of the next big opportunity or big thing on our market. So yeah, feel free to approach us for any further details around this new product. So that concludes our presentation. Thanks for participating. Have a good day and enjoy your Xmas season and New Year. Bye-bye.